study unit 14 is looking at the non-current. We just looked at the current, right? So what is current? Short term.
That's the short term.
Within 12 months. This is long term, so this is
Longer than 12 months.
outside the 12 months. Okay, that example that we discussed from the study guide was perfect. Why? Because it's disclosure. Okay, so in that example, you had 600,000 as the loan. 200 was paid within 12 months.
Yeah.
400 is going to be paid 2 and 3 years after the year end.
Yeah.
And that's why we're going to separate it into long-term and short-term. That's the only reason why you do it. Okay, so when looking at non-current liabilities, what did we say we're going to be using these for? Which assets? Non-current. Okay, non-current liabilities buy non-current assets.
Okay.
Okay, because you're not going to buy a house with your credit card.
Yes.
Okay, you're going to use a home loan to buy the house. Right, because obviously price or interest would be a factor, but it's because of the time. Okay, the period. Okay, so obviously a home loan is a long-term loan. Okay, a house is a long-term asset. Okay, so if I look at financial position, it depends on your assets liabilities. We spoke about that. There's the revision bits. Companies require more assets than liabilities to avoid becoming.
Broke.
Yes, bankrupt. Exactly. Yeah, insolvent. Right. So a business that has more liabilities than assets will go bankrupt.
Yes.
Okay, because they can't meet the obligations.
Yes.
If liabilities are greater than assets, what are we in? Good position, right?
Yes.
So if that's the case, then we're a going concern. So that's theory. We've spoken about going concern back in the beginning when we looked at qualitative characteristics. Okay, going concern means I'm not going to go out of business. Okay, this business will continue. Liability, obligation is the keyword. We spoke about that. We spoke about it for a current liability. The same thing applies for a non-current liability. Why? A liability is still a liability. It doesn't matter if it's short-term or if it's long-term. It still meets this definition. Okay, that's why definitions are key. This is just looking at the timing. So study unit study unit 13 and study unit 14 is looking at the time associated with each liability. You can either have a long-term liability or you can have a short-term. Same as before. When we looked at assets, we looked at lots of different assets. We looked at current assets, which were inventory. We looked at debtors. Okay? Then we looked at long-term. We looked at PPE, property, plant, and equipment. And long-term, which was the, what do you call those things? Those non-financial, or those financial assets. Okay, we looked at those like shares and investments in and that type of thing. Right, remember that wasn't so important. It was like 2 pages in your study guide. Okay, that was the last bit. So here, we're focusing on theory. If I'm not a going concern, that means bankruptcy, means insolvency. So the key is, can we pay off our liabilities? That's always the answer, or the question. And the answer is going to tell you if you're going to be able to operate or not. Okay, so obviously all businesses go through difficult times, right? So certain businesses struggle in certain markets. Okay, so in a recession, businesses do bad. In a expansion, businesses do well. But as long as the business is managing its assets and liabilities, it doesn't matter what's happening in the market. If it's a good market or a bad market, you're still going to be able to operate. Okay, because this should be more than that, then you find. Okay, that's why this chapter is looking at it, because we need to determine which is more risky. Okay, the non-current or the current. So give me some thoughts. What do you think? Which are more risky?
Long term.
Why?
Because it's greater than 12 months and it's bigger amounts.
So you're saying long-term assets are more risky.
Yeah.
So is a home loan more risky than a credit card?
Not really.
Okay, you need to define what risk are you looking at. You're not wrong, you just need to be more specific. So if you're talking about a home loan as being more risky, why is it more risky? Just explain. about it. What happens if you don't pay off the home loan? You lose the house.
Okay.
That's risky, right?
Yeah.
Okay, so if you're not paying off your home loan, you're eventually going to lose the house. See, that's
so your property, plant, and equipment will be the risky ones.
well, not risky. See, it's relative. Okay, so would you pay more on a home loan in terms of interest or less compared to a credit card?
Less.
Exactly. Why? Because the bank can take the home if you don't pay.
Oh, okay.
Okay, what do credit cards normally get used for? Travel.
Yes.
Okay, so what is the bank going to take? There's nothing to take. Okay, they can't come back and take the time that you spent at the hotel, okay, if you went on holiday. Right, that's not something that they can repossess, but they can take the house, they can take the car, they can take the machinery. Okay, so when you talk about risk, long-term liabilities are normally secured. Okay, when I use the word secured, I'm talking about the word collateral. Have you heard that before? Okay, collateral means the house, the car. It means an asset of value that's put against the loan as like collateral. The right word is collateral. Okay, so the laptop could be a form of collateral if this was financed. Okay, so if you were paying for the laptop over time, well, if you stopped paying, that supplier might be able to come and repossess it or take it away. Okay, that's basically what a home loan is about. A home loan is looking at. What's wrong? Oh, okay. All right. So the home loan is basically a liability that's covered with an asset. Okay. So if you talk about risk, you can, but then you're talking about this collateral. See, if you said high risk, then you're not talking about that. You're talking about this, the rates. Okay. So there's different things. It's all theory. Okay. This is just a debate. It's just to debate which is better or worse. Is there a better type of credit? Okay, so which do you like better? Do you like current or do you like non-current?
Non-current.
Why?
Because at least you have a house and a car. And
Okay, you have an asset of value, exactly.
Yes.
Okay, so non-current liabilities aren't bad because you're financing something good. Okay, it's better to buy more property and to buy more machinery and to buy more equipment than it is to pay for more expenses.
Exactly.
Okay, so current liabilities would be used for things like that. And that's why here you've got slightly more risk, but this is risk in terms of no collateral. Okay, because there's nothing that backs up the loan. Okay, so if you can't pay, you can't pay. At least with the non-current, if I can't pay, I still have an asset. There's still something. Okay, so it's purely discussion. And obviously, I just put a note here about the interest rates. Obviously, rates on a credit card would be a lot higher than rates on a bond. Okay, a home loan. Purely because of that risk thing. Okay, the banks know that they can take the house if you don't pay. Right, so that's why for them, charging lower interest rates isn't a problem because even if they don't pay, they still have some sort of recourse. Okay. So is there a better type of credit? Which one do you like better?
Non-current.
Non-current, still non-current, okay? There's no right or wrong answer here. It's all about the management of it, okay, the credit. And that's why in this chapter, they're talking about a control account, something that's used to monitor what we actually have in the business. Okay. Right, so as long as you manage credit, that's the important bit. No one wants to be in debt. Debt is bad. Okay, as long as you view credit as long as you view credit responsibly, like you're not abusing credit, you're using it responsibly, and you're using it for the right things. Okay, so if I'm buying property with my debt, that's good. If I'm using debt to have fun and parties and all of that, that's not responsible. Okay, because there's nothing left over after that. Okay, at least with a non-current liability, there's something of value. That's the key. The value of the asset. Okay, the collateral. Okay, so in this chapter, they talk about obligations and they talk about long-term obligations with bad consequences. If you don't meet those obligations, what's going to happen?
assets.
There could be repossession, that's one thing. What else?
They could blacklist you.
They could blacklist you, exactly. Okay, good. So when looking at accounting, when am I going to record the liability? When it arises, right? Okay, so if I record the liability, accounting recognition of liabilities occur when what exists? When is a liability, or when is a liability liability?
When you owe money.
Yes, so the keyword is obligation, obviously. Okay, that's always the keyword. Okay, so if there's an obligation, and that's, so the nice thing about these chapters is it basically reinforces the basics from previous chapters. Because if you know what an obligation is in terms of like owing someone something, then you know this is a liability. Okay, it doesn't matter what scenario you're in. Okay, so if I buy stock and I didn't pay for it, is there an obligation?
Yes.
Of course there is. Okay, you can't take stock without paying for it.
Exactly.
Right, so that creates an obligation, it creates a liability. If I'm looking at recognition and measurement, same thing applies here. We saw it in the current, you can see it here in the non-current. The same thing applies. Its cost is realizable as current value. Same as your like bond home loan. Every month, as long as you're making payments towards the bond, it should be coming down, okay, decreasing. So you can't record the bond at the initial price. Okay, so if you took out a loan 10 years ago, you can't record that.
No.
Do you agree? You record the bond's value today. Okay, how much do you owe today? Not how much you owed 10 years ago. Okay. Debit the expense, credit the liability. We spoke about that. That's buying assets or expenses. Okay, buying assets or paying for expenses. Is borrowing a non-current asset?
Yes.
Why?
Because it says so.
There's an obligation. Okay. Right, borrowing creates an obligation. Mortgages creates an obligation. Are they important? Yes, because they finance assets. Okay, that's why we had property, plant, and equipment. PPE. Would PPE exist if we didn't take out a loan? Probably not. Think about it. Okay, if you had to buy everything cash, how long would you have to wait to buy a house?
Forever.
Probably. Okay, well, it'll be difficult to buy a house cash. Why? It's an expensive asset. Okay, but does that mean you don't take out a loan to buy a house? No, you can. Okay, or a business. For example, a business is probably a better example. Okay, because does the business operate? Yes. So can the business operate if the business doesn't have assets? No. Okay, if the business doesn't have a building, if the business doesn't have like machines and things like that, the business can't work. The business can't operate. Okay, so obviously like those mines can't do anything if there's no machinery. Okay, so at some point in time, those machines need to be bought or replaced or repaired. Okay, so those assets are important because you're adding to your capacity. Right, if I've got one of those machines or if I have 10 of them, obviously production or capacity is going to be different. Okay, so with disclosure, am I going to disclose the non-current liabilities in detail? Yes, you do. Why? Because they're important liabilities. Because we just said, if we don't meet these obligations are going to put us out of business. Okay, if you lose the house, if you lose the car, if you lose the machinery, etc., right, then the business totally collapses. Okay, the business can survive if they lose some debtors. Okay, I mean, if some debtors don't pay, it's not going to put the business out of business.
Yeah.
Right, but if the business loses its land and buildings, that's a different story.
Yeah.
Okay, so with disclosure, we need to categorize and we need to record all the detail relating to the property, plant, and equipment's financing. Okay, because this is non-current liabilities. And that's why you also need additional disclosure here. Okay, remember we spoke about notes to the financial statements? Okay, and we looked at the property, plant, and equipment note. You'll have a note for this. Okay, you'll have a note for all of these different things. Okay, because notes give you more detail. That's all it is. There's the notes. Okay. Right, so just a simple example here. This actually came from the textbook. So I looked at debentures here. Debentures are long-term assets. Why? They're issued in, let's say, what's the right word? They're issued in like portions. Okay, units. Okay, let's just use that word, units. It's there. Okay, so a debenture is like a loan that's split into many different loans. Okay, because think about it. Would it be easy to take a large amount from one lender, or would it be easier to lend a little bit from many people?
Little bit for me.
Exactly. Okay, and that's what a debenture does. A debenture is just a type of debt instrument which is similar to shares, where I can take a big amount and I can split it into small amounts. And I can ask people who wants a part of the loan, basically. Okay, so if the company wants a big amount of capital, they can split it into different, smaller loans. Okay, so that's basically what a debenture does. So, question here. If I hold 200,000 worth of debentures, and the debentures are 100 Rand each, how much units do I have? Yes, you divide by 100. Perfect. Okay, so 200,000 divided by 100 would be 2,000 units. Okay, I just put a note there. Format is important. You need to obviously disclose everything correctly. Okay, so you would literally write down all the detail, and that's it. Okay, is that right? Okay, just a note here about disclosure. Statement of financial position records what? Assets and liabilities. Statement of comprehensive income records what? Income and
Expenses.
exactly. Okay, so that's what I'm looking for. So obviously next week we're going to look at disclosure, chapter 15. Okay, study unit 15. And in study unit 15, we need to emphasize disclosure. We need to identify what things are because we need to disclose them correctly. Okay. And that's the end of that theory bit. Okay, so obviously, as I said, try if you can, go to the study guide and go through more of those practice examples. That's actually better. Okay, because then once you've done that, we can check areas that you're struggling with, and then I'll obviously cover past papers with you as we go.